Bharat. This session will focus on key priorities for infrastructure development, emphasizing two critical areas: cross-border payment systems and international investments. Through this dialogue, we aim to unpack the existing framework's challenges, inefficiencies, and systematic barriers and explore actionable strategies to foster inclusion, resilience, and equity in the global financial architecture. Let us collectively identify the pathways for reform that can benefit advanced economies and ensure robust participation and empowerment for emerging markets and developing economies. Let us begin this session. Key priorities for infrastructure development, in which cross-border payment systems we have to analyze. The current framework for cross-border payments heavily relies on a network of correspondent banks that act as intermediaries. This structure imposes significant limitation on payment speed, influenced by the operational hours of real-time cross-settlement system and the variability of a national regulatory standards. As a result, cross-border transactions are often slow and inefficient. Additionally, the predominance of payments conducted in leading global currencies ties the system to the monetary policies of the issuing nations, creating vulnerabilities, particularly for developing economies. Over the past decade, the correspondent banking network has undergone notable contraction. Heightened compliance requirements have increased bank operational costs following major anti-money laundering, lapses, and the imposition of hefty fines on large institutions. Consequently, many banks have become more selective in maintaining correspondence relationships, leading to a global reduction in such networks by 20% between 2012 and 2018. This decline has been most pronounced in Sub-Saharan Africa, Latin America, the Caribbean, European, and the Central Asia, where over a quarter of surveyed financial institutions reported restriction in accessing correspondent banking services, particularly for USD and Euro transactions. Although some realignment has occurred, with the correspondent banking networks shifting partially away from the West and Europe, whose combined market share fell from 73% in 2013 to 60% in 2019. This rebalancing has not fully offset the decline in participants. The result has been longer and more expensive transactions chains, negatively impacting cross-border trade, remittances, and exchanging essential commodities like wheat. Another critical issue in cross-border payment is financial messaging. Despite advancement in international financial mechanisms, interbank information exchange largely depends on legacy systems governed by centralized regulations and often operates with outdated technologies. While the interbank messaging network reported in 2023 that 89% of cross-border payments are settled within an hour, surveys conducted among BRICS economies highlighted persistent challenges including delays, high transaction cost. For example, foreign exchange spreads of 2.5% in Brazil, 8.5% in Africa, and up to 20% in some cases, and a lack of pricing transparency. Emerging markets and developing economies requires more efficient systems to capture better the economic benefits they generate for the global economy. Although alternative systems are emerging, they face significant barriers to adoption due to the interest network efforts of the existing model. Integrating new systems into the intricate web of global financial institutions and regulatory frameworks is a monumental challenge. Furthermore, extraterritorial sanctions often hinder these alternatives, even when transactions involve non-US entities, currencies, or infrastructure. This regulatory landscape further entrenches inefficiencies and reinforce the dominance of existing system, posing a major obstacle to progress. It distorts the market as a single entity, effectively controls the critical component of the IMFS. This monopolization denies participants viable alternatives and disproportionately affects the most vulnerable emerging markets and developing economies by eroding their net income through high transaction cost. Consequently, the existing system falls short of meeting key principles for improving the IMFS, particularly regarding the independence and inclusions. Global stakeholders may need to reconsider their approach to cross-border payment to address this issue as outlined in the requirements for establishing an alternative payment and financial system. Instead of relying on one or two dominant alternative currencies that fulfills criteria such as accessibility, stability, and infrastructure, they could utilize existing technologies to enhance transparency and optimize the price discovery process. This approach would enable the participants to convert any value they hold into desired unit of value required for trade, shifting the focus from identifying an ideal medium of exchange to refining the mechanism of exchange itself. In this context, the unit of value need not to be limited to national currencies, but could include diverse assets such as central bank digital currencies, asset-backed tokens, or currency baskets. However, this mechanism's success would depend on their effectiveness of the price discovery process. The true price discovery requires participants to commit to trade when their proposed exchange rates are matched, emphasizing the need for a trading platform or exchange to facilitate this process. Next is the international investments. The dominance of the Western financial markets in 1980s led to an infrastructure including exchanges, clearing houses, rating agencies, and depositories that played a central role in the global capital markets. These systems provide participants with an efficient framework for investment by offering liberalized market access and high liquidity, which reduce cost and enhanced price discovery. As capital markets expanded in size and complexity, their components becomes less interchangeable, making it increasingly difficult to integrate alternative systems. This rigidity has rendered the existing infrastructure less adaptable to the needs of an evolving global economy. For emerging markets and developed economies striving to attract and deploy greater capital, this inflexibility has become a significant constraint within the IMFS. This structural rigidity leads to higher cost for participants and inefficient resource allocation. Domestic capital markets in emerging markets and developed economies struggle to achieve sufficient depth, with liquidity often redirected to dominant financial market, especially during the periods of heightened volatility. For example, at the peak of pandemic, foreign investors withdrew over 100 billion greenbacks daily from emerging markets and developing economies. The structure of capital markets requires reassessment, as data reveals a significant shift in the global capital markets landscapes from 2012 to 2022. During this period, the share of developing nations and BRIC economies in global capital market increased from 15% to 25%, with the proportion of global debt rising sharply from 8% to 23%, while equity contributions remained steady at 27%. However, this market remains predominantly domestic, as over 94% of holdings in BRICS economies are owned by residents, contrasting sharply with developed markets, where only 69% of holdings are resident owned, a decline from 72% in 2012. This disparity highlights those emerging markets and developing economies, including BRICS nations, have not fully capitalized on the benefits of globalization, such as attracting foreign capital to domestic markets. Greater foreign participation could lower borrowing costs, though higher debt demand and enhance opportunities for equity financing. In contrast, the performance of advanced economies since the global financial crisis underscored the efficiency of capital market structures in enabling flexible capital allocation across asset classes. From 2008 to 2022, marked by quantitative easing and loose monetary policies, developed markets saw their equity markets triple in size, while outstanding debt markets grew by 50%. During this time, non-resident ownership of equities rose from 29% to 38% and non-resident debt ownership remained stable at 27% to 29%. Conversely, the emerging market and developing economies experienced a decline in non-resident holding in equities and debt during the same period. Equity holdings by non-resident fell gradually from 18% in 2008 to 15% in 2022, while debt holdings experienced a sharp drop from 16% in 2008 to just 7% in 2022, despite a temporary recovery to 23% between 2010 and 2015. The departure of non-resident investors from the emerging markets and developed economies debt markets has likely hindered their growth, with current market capitalization estimated to be 7% to 12% lower than it could have been under more favorable conditions. While it is a common practice to categorize the investable market into developed and emerging segments, it is clear that countries within these groups are far from uniform, with significant differences in economic performance. A closer look reveals that, on average, financial returns from certain emerging markets over the past decades and 2 decades have outperformed those from some developed markets. For instance, US equity market has delivered annualized return of 10.6% and 13.8% during 2002 to 2020 and from 2010 to 2020 respectively. In contrast, UK equity market provided lower returns of 5.8% and 3.9% during the same periods, adjusted for currency exchange rates probably. Meanwhile, Indian equity markets achieved 14% and 6.6% annualized returns over these time frames. A similar pattern is observed in corporate non-highly yield debt markets, while some portfolios from emerging and developing economies produced higher long-term annualized returns from 2002 to 2020 than US markets, even when adjusted for currency fluctuation 6.2 compared to 5.6. These variations in financial performance are not surprising, while this analysis does not allow to position emerging markets and developing economies as inherently superior destinations for capital investments. It underscores the importance of providing equitable opportunities for non-resident investors in all viable markets. It is essential for maximizing the potential of diverse investment opportunities. The composition of non-resident investors in emerging markets and developed economies market reveals an interesting pattern. Advanced economy investors dominate, representing 83% of all non-resident holdings, while offshore entities contribute an additional 14% as of 2022. In contrast, portfolio investment shared among BRICS nations account for only 0.4% from the following table, which you can see on the screen. The limited engagement of non-resident investors in the emerging markets and developing economies can partially be attributed to differences in financial returns and perceived risk. However, unlike the interconnected investment flows observed among developed markets, this does not account for the lack of investment activity between the emerging markets and developing economies. This disparity is often explained by excessive centralization in global financial system. To access the capital markets of developing country, investment must frequently be routed through established hubs like West. This centralization creates a structural advantage for investments directed towards developed markets, which benefit from direct financial links, while transactions between emerging markets and developing economies requires more complex and less efficient arrangements. Essentially, investing between emerging markets and developing economies often entails an indirect and cumbersome process even when countries are geographically close, whereas investment flows from advanced economies to emerging markets and developing economies follow a more straightforward path. Addressing this inefficiency is critical, especially as emerging markets benefit from growing interest among sovereign wealth funds, which have shown optimism about emerging markets and developing economies, potential to outperform developed markets in the coming years. However, structural barriers limit emerging market and developing economies' ability to attract and facilitate non-resident investment. One major challenge is how credit rating agencies assess sovereign and corporate risk in emerging market and developing economies. Sovereign ratings are often downgraded due to limited or incomplete data, a problem exacerbated by centralized and the West dominated credit rating industries. It has several cascading effects. Sovereign downgrades negatively impact corporate ratings, even for financially sound companies. The sovereign ceiling principle causes all debt instruments within a downgraded country to suffer, imposing disproportionate burdens on corporates. Higher cost of capital, wider credit default swaps, spreads, and weakened domestic capital markets further erode investors' confidence. This systematic bias in credit rating arises from multiple factors, including subjective judgment, government lobbying, and West-based rating agencies' inherent challenges in assessing emerging markets. These issues contribute to uncertainty, resulting in lower credit rating for emerging markets and developing economies despite their financial fundamentals. Additionally, the centralized nature of global capital market amplifies inefficiencies. Smaller market participants in emerging markets and developing economies often lack access to established financial infrastructure, forcing them to resort to riskier bilateral trades or inefficient capital raising methods. Such limitations hinders the ability to attract long-term financing, undermine cross-border investment initiatives, and exacerbate inefficiency in global market. The systematic flaws also conflict with the principles of inclusion and sustainability within the international monetary financial system. Extraterritorial restrictions and the concentration of power within the financial hubs continue to impede the development of robust and inclusive capital markets in emerging markets and developed economies, making it imperative to rethink the existing centralized investment architecture to ensure greater equity and resilience in global finance. Hence, viewers, thank you for participating in today's discussion in strategic initiative to enhance international monetary and financial systems. We have dwelled into pressing issues surrounding cross-border payments and international investments and collectively explored avenues to make the IMFS more inclusive, transparent, and sustainable. Your insights and contribution have been invaluable in shaping a clearer vision for addressing the structural and systematic barriers impeding global financial equity. Let us carry forward the ideas and recommendations discussed today to build a stronger and more balanced international financial framework. We look forward to continuing this critical conversation in future sessions.